This is the current federal tax developments for the week of February the 8th, 2021. Current federal tax developments are brought to you by Kaplan Financial Education and by your state Society of CPAs. It's Zollers coming again this week from Phoenix, where weather's pretty nice outside right now. Won't stay that way as we head towards summer, but at least for the moment, we're looking good. And we'll be talking this week about what we had developed in the area of federal taxes. This week is relatively calm. Not a whole lot's been going on, at least not in terms of court cases and IRS guidance. Obviously, you have some things going back and forth in Congress, but that's not getting anywhere real quick. So we're not going to really worry about any proposals there until we get a lot closer to an actual piece of law. So what we will talk about this week, though, is that the final Form 1040 instructions have been noticed to cause some real confusion with relation to how you're going to answer the virtual currency question here. We also got an IRS notice coming out, or basically a revenue procedure, that was a safe harbor relating to the additional items that were added to the teacher's classroom expense deduction for COVID-19 supplies. We have the IRS's safe harbor about what can be added to that list. We also have the IRS responding to a letter from a constituent to a congresswoman, which talks about the problems he may have because he had unused flexible spending account dependent care benefit funds in the 125 plan. And when his summer camp for the kid was canceled, there was no place to spend it. He was wanting to know if he'd get a refund, and the IRS doesn't have good news for him. And finally, we're going to talk about the IRS granting relief for filing information returns for certain returns of income that would have been related to various aid programs that we found for COVID-19. And the IRS then goes on and says, by the way, for banks that already issued some 1099 miscellaneouses under one of the programs, they effectively order the banks to amend those 1099s, and with a strong implied threat that if the banks do not do so within 30 days, they may face penalties. So we'll talk a little bit about that routine. But let's go with the first thing this week, and we're going to talk about these final 1040 instructions that came out on January 6th. And what's been noticed is there's a little quirk in them. And so what we have here is these draft instructions came out on December 31st. So right at the end of last year, we had draft instructions. And in those instructions on page 16, the IRS was addressing how you're supposed to answer this question that now is on the front page of the 1040, saying at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? In the draft instructions they had on page 16, they list a number of example situations in which a taxpayer should check that box yes. And two of them in particular were ones that would be changed in the final regulations. The first one said that you need to check it if you had a purchase or sale of virtual currency during 2020. And then the second one said if you had an acquisition or disposition of a financial interest in a virtual currency during the year, you had to check the box yes. Now, a week later, and it literally was a week later, the IRS put out the final version of the 1040 and 1040 SR instructions. And when they did so, they went back into those two statements and got rid of the purchase and the acquisition side of the statement. So now it says you have to check yes if you have a sale of virtual currency, or you need to check yes if you have a disposition of a financial interest in virtual currency, along with a couple of other options. Now, the question, of course, was raised, well, why did that disappear? Did that disappear because it means those are no longer items that have to be reported? Well, one problem we have with that is the question on the front page of the 1040 was not changed because that form was still final. And that form clearly says at the end, any other or otherwise acquire any financial interest in any virtual currency. And we've yet to be told exactly what that means, but it would seem likely that most of us would think the purchase of a virtual currency would be acquiring a financial interest in such a thing. And to go to the height of absurdity, you would expect that an acquisition of a financial interest in a virtual currency, which is what was in the instructions that said you had to check yes, would be otherwise acquiring any financial interest in any virtual currency. Now, you think those are basically the same statement effectively. So how could it not mean check the box yes? Well, the question became, of course, then why were they pulled if the idea is we don't, we still need to check the box yes? Why did we change that instruction? So Tax Notes, who was writing up a story about this and talked to a couple of practitioners in the area, well, they finally go hold of an IRS spokesperson, and that spokesperson was quoted as saying that if the only activity someone has is a purchase or acquisition and hold, then they don't have to check the box. Okay, except that goes literally against the actual wording of the question, which is concerning. Now, we have some speculation in the article about why it's that way. I think part of it may be the IRS is, to be totally honest, from my standpoint, the IRS is still aiming to figure out what they're looking for in this question, how they want it worded, and therefore, they really don't want to just know that you bought some virtual currency just on a lark, and we are not really doing anything. It's sitting there. You're not buying stuff with it. You're not selling it. You haven't done anything that would generate a tax issue. But they also don't want to write it in such a way that somebody would try to read the instructions to indicate that, nah, okay, I'm just not going to do this because it creates taxable income, but I think the way I read their instructions, I can skip doing this. So they're trying to walk that tightrope. The problem is, of course, if you're talking to your client, how do you answer the question? My quick take is that I think you still got to answer the question, literally the question being asked. If they're asking you, did you acquire any virtual currency? It seems like that's a thing you answer yes if you acquired it. You don't answer it no just because we took the acquisition statements out of the instructions, unless the instructions had an explicit statement stating that, yeah, I know the question says, did you acquire, but we really don't mean that anymore. So would you please not answer yes if all you did was acquire, but it's not in a transaction that would have generated any sort of taxable event? Yeah, I mean, they're trying to figure out how to word it. I know that's what they're after. And they did state in the tax note story that, yeah, they're continuing to look at that and their instructions and the wording of the question. I think obviously they've had a change of heart late in the game after the 1040 was approved and very late, after we got the instructions virtually ready, because obviously we put out this new draft with this change and then suddenly undo it and put out this, 1040 final instructions. So we'll have to see what goes on, but obviously that will continue to be a concern for us, is how exactly are we going to handle that when we end up with this issue? Because the IRS response just frankly did not resolve this issue. Rather, it left it more open and more confusion regarding to what exactly does this question mean. Next up, we're going to take a look at Revenue Procedure 2021-15. This was added as part of the COVID-related Tax Relief Act of 2020. And that bill added something that, well, it's okay. It was added, and I understand why. And it sounds good at first. It's just a practical matter. I think it's going to make almost no difference. And that is, they said classroom teachers will be able to count for their above the line deduction COVID-19 protective items. They can claim that deduction if they're paying out of their pocket for COVID-19 protective items. They can claim that as part of their above the line deduction. Now, the IRS in this revenue procedure provides a safe harbor, and what they do, this gives us a non-exclusive list of items that the IRS indicates would qualify. So again, non-exclusive means it includes but it's not limited to things such as face masks, disinfectants for use against COVID-19, hand soap, hand sanitizer, disposable gloves, tape, paint, or chalk used to guide social distancing, physical barriers such as clear plexiglass, air purifiers, and other items recommended by the Centers for Disease Control to be used for prevention of the spread of COVID-19. Which is all well and good. We know what would qualify, and I think most of us could figure out most of that stuff that would qualify. If your teacher is buying masks that they're taking with them, into the classroom, they're buying the sanitizers. Okay, all that stuff, fine. We understand it. Of course, the practical problem is that above the line deduction is still limited to $250 maximum. While Congress added expenses to the list, they did not add any extra room to deduct them. And at least in my experience, the teachers I've worked with generally were maxed out at 250 anyway before we ever got these in here. So I don't know if there are many teachers that are going to find a real benefit from this. But if you do, we now have a list, so these things go on there. I think sometimes Congress does, I'm a little cynical, they do realize that people don't pay a lot of attention about the tax benefit they get from something if they're told it's deductible and they get to write it down the right box in your organizer. They feel good and they feel like it's great, it's doing wonderful things for them. It's like, yeah, in reality, this one is doing virtually nothing. For the teachers, it's practically a non-event, but okay, we've got guidance on it. Next up is bad news for a participant in a cafeteria plan. This is information letter 2020-0027. This came out on New Year's Eve. Well, that's when they released it. Actually, the letter was written in September, and that's somewhat important as we're going to discuss one additional modification that occurred on December 27th. But this was a taxpayer who said that he had begun deferring to his dependent care flexible spending account. And what he was looking to use the money for was to pay for summer camp for his kid. Now, the IRS is going to have a little comment about that too, because in one sense, it appears, is this really an employment-related child care? Maybe the child was in school all that time. Maybe they go to summer camp for the time they're off in the summer. But it's kind of odd that the only thing you're saving for is this summer camp, which normally is not going to run the entire time they're out of school in the summer. So it's, the IRS is a little skeptical about whether this is really daycare necessary for employment purposes, and they remind the taxpayer actually in this letter about that little detail. But let's assume for now that this is valid expenses. There's no question. It's not, they're not just saving for this and, otherwise don't ever have any child care there. That'll be this side. We'll just go ahead and we'll accept that. Well, of course, COVID-19. So basically, the beginning of 2020, they had started this deferral project, and obviously they're deferring and they're aiming for funds to be there. So in the summer, they will be able to pay for this summer camp for the child. So the money will be there. They'll be in great shape. It'll be ready to go. Well, COVID-19 hits, and not surprisingly, the summer camp got canceled. Right? So we didn't have summer camp last year, so there was no camp to send the child to. Nevertheless, there were funds in the cafeteria plan. And while the employer basically, allowed the employee apparently here to stop deferring, the problem is there were already a lot of months in there. By the time it became clear that summer camp wouldn't happen, I suspect we were sitting at least in April. So we had at least one quarter's worth of money in there. And it could very well have gone all the way to May or June, depending upon what part of the country they were in, how things were running. If you remember, we had a story about a couple of camps in June where the camps had opened and things didn't go so well. These tended to be for older, kids. But again, we don't know the age here. Obviously for childcare, 13's the end. So we got to know it can't be beyond that age frame. But it is one of those things to say, yeah, it could have been 4 to 5 months in before they became aware that, hey, this isn't going to work. Secondly, the IRS didn't publish that relief that told employers it was okay to allow people to change until we did get into May. So, probably there were at least 4 months there and maybe 4.5 or 5 months in the pot when we discovered that, in fact, there was going to be nothing to pay for this year. So this constituent of the Congresswoman is asking, and so Congresswoman's staff sends this on to the IRS, can the employer pay him back the difference? Is it allowed? They took this money. It was to be used for the camp. The camp's not going to happen. Can't I just get my money back? Won't they allow that? And he pointed out that he knew that they had allowed people to stop deferring. So, obviously nobody anticipated the pandemic. So shouldn't we be able to take the money back that now, we know we won't be able to spend in 2020. We have no plans. No plans are going to absorb this money before we get to the end of the year. And the IRS said, well, unfortunately, the answer is no. You're not going to be able to get this money back because the problem is under a cafeteria plan, the only thing this money can be used for is to pay for dependent care benefits. And in fact, that's part of what they remind them. Dependent care benefits to enable the employees to work. So it's got to be employment related issues. And they're saying, nothing here allows a refund. Yes, we did change to stop the deferral, and that was relief the IRS granted this year, and officially that's not allowed. But the IRS did allow for that. But that relief did not go back and change the rule in saying that you could get a refund of those excess payments. So as the IRS is saying, it's tough luck. That's one of the risks you take with these FSA accounts is if something comes up and you cannot spend the funds, you're out them, right? This is one you're simply out the money. Remember, you're excluding this from your income for the year, so that's the trade-off. Otherwise, if you don't want to take that risk, you could just go ahead and not defer there and then pay for it with after-tax dollars, and then if it turns out there is no camp, you'd have no risk. Now, Congress did on December 27th make a change. And at December 27th, we actually did have a change that came in at that point in the Taxpayer Certainty and Disaster Relief Act of 2020. And it allowed for the taxpayer, this is in Section 214 of the Act, we have a lot of cafeteria plan relief. And specifically with regard to dependent care benefits, the plan, if it wants to, the employer could amend the plan or agree to amend the plan. It'll be in 2022 when they have to. That it's going to allow during 21 and 22 plan years ending in 20 and 21, I should say, it's going to allow the employees who have unspent FSA funds, whether they are health care or dependent care, and you apparently can switch between the two, whichever one you could do for one, not the other, whatever. You can go ahead and have those just roll into the next year without limitation, and be used the entire following year. So I don't know that that would solve the case here because the question is going to be, would you incur child care expenses in 21 that are large enough for this? There was a second fix, though, because one other potential problem was, let's assume that child who was going to have this care provided was 13 last year. Well, 13 is the last year you can get the benefit, so the child would age out. Another provision found in Section 214 of the Act was that if you did have an aged out child, a child who was, 13, the year you are funding for which you're going to have these unspent funds, was the last year the child could qualify for child care benefits. If that was the case, only with regard to the overpaid, not overpaid, but the unspent funds from this year, in the following year, you can go ahead and we will go ahead and let you still pay for child care for that child, but only up to the amount of the unspent funds from the year when they were 13. You can't add to that amount. We've got restrictions on it. It's meant to be relief only for that child. So there is relief here. Again, would that relief solve it for this taxpayer? Well, let's assume the camp's fine. Let's assume it'd be fully deductible. The problem is we're still sitting here with a lot of uncertainty in many parts of the country about whether or not such camps will go on. And it's a practical matter that's actually two different things. First, will they be allowed to open by the governmental agencies? But number two, even if they're allowed to open, the camps have to make a decision. Will parents be comfortable sending their child there? Because even in parts of the countries where schools have reopened, we have a number there that have, there's still a contingent of parents that aren't comfortable, and as long as there's an option for remote learning, they're using it. So the problem is with the camps, what percentage of your parents would not be comfortable sending there? So if you're this guy looking at this and saying, okay, I can roll it the next year, well, okay, but what happens if the camp doesn't go off this year? Do we get another year and will they let me go to 15? I don't know. I have a feeling that that'll be an interesting aside to look at. A lot may depend on how the next couple of months go in that area. And again, that'd be for this specific case. But again, the longer we go, the more likely in some cases that we're still going to have unspent dependent care benefits. And it may even be of such a nature, if it lasts long enough, that we can't use just what was left over from last year. I'm going to assume most parents who had leftover from last year are going to be a little bit, shall we say, cautious about re-upping the numbers. And since the plan can allow for mid-year changes, my guess is most parents will not going to start looking to add to it until such time as it's clear they're going to use up whatever carryover came into the year. So that's our background. Next up, this was Notice 2021-6 and Announcement 2021-2. And these announcements and everything came up. This involves the information return, right? Information return filing issues. And what this is going to do, Notice 2021-6 was issued on January 19th. Announcement 2021-2 was issued on February 1st. In the comprehensive, get it right, Comprehensive Appropriations Act, I always want to say the wrong names there, of 2021, we had a number of provisions added to the law that made various COVID relief items non-taxable, expenses paid with the funds deductible, and gave us flow-through basis for our pass-throughs once we had the cancellation of debt. And, the best known of those was obviously the Paycheck Protection Program loans, but we also went back and did this for the Main Street Loan Program. We went back and did it for the EIDL advances and grants. We did it for the payments the SBA made on 7A loans for borrowers for a period of time. And we finally are going to do it on the shuttered venues grants that are coming up. Well, Congress knows that generally all of that previously would have been taxable. Either it might have been miscellaneous income, it might have been a 1099-G for cancellation of debt, but they would have been taxable items. So they said, we're going to go ahead and allow the IRS to issue notices that will take away the requirement to issue those items. Prior to the act being passed in December, and back when it looked like we might not get an act, the SBA had put out a memo to the banks specifically about that program where the SBA was making payments on the 7A loans. And the SBA said that banks, you need to issue a 1099 miscellaneous to the borrower that has that amount that we paid for them as miscellaneous income during the year. And they'll have to report that as taxable. Well, a number of banks had been issuing those forms, despite the fact that on December 27th, the law was changed and Congress had directed the IRS to issue some sort of guidance that would get rid of issuing those things. The IRS did issue that guidance. That was under Notice 2021-6. Basically said, banks, you don't have to issue this. It's not required. Please don't do it because, of course, it's going to mix up the matching. And if you have, would you please, please, please get it amended? Another interesting aside in the midst of this, because I've had people ask me this, it also makes clear that the amount of interest the SBA paid for under those payments for these 7A loans under Section 1112 of the CARES Act, that payment of interest made by the SBA is still deductible by the taxpayer, by the borrower, because they tell them on the 1098s, you want to make sure on the 1098s you include that interest because the borrower is able to deduct it, and we could have mismatches if you don't. So don't reduce the interest. Report it to the borrower by what the SBA paid, how much interest they paid. Report the full balance there. So that basically told us we're going to get the deduction for that interest that the SBA paid for us, which was how I read the law, and been kind of just glad, though, to see the IRS actually confirm that. I would have said the IRS would have been wrong had they tried to say otherwise, but again, it's always nice to know that this happens. Now, the problem, as I said, was, though, a number of banks had already issued 1099 miscellaneouses. Now, in the initial notice, the IRS was kind of, please do this, it'll foul us up, and we can't do the matching right, and it will cause us problems. But the tone there was kind of a, well, yeah, you don't have to file these forms, right? And the implication was, if you don't want to, And, and it would be nice if you would amend if you had. But it didn't really seem to suggest that they had to do so. I suspect a number of banks read that, and when this came out in the latter part of January, they said, "Well, there's not time. We're not rewriting our software to basically to eliminate these 1099s." And because we'd have to rewrite it, we'd have to change, we'd have to do some testing, we'd have to figure out if it's working right. There's just not time to do that. So we're going to go ahead and issue it. IRS said we didn't have to. Well, we're okay. Maybe we don't have to, but we're just going to go ahead and do it. In Notice Announcement 2021-2, the IRS took the gloves off. In this announcement, they've effectively ordered the banks to go back and for those 1099 miscellaneouses, to undo them, to basically void them out, right? Have a corrected 1099 miscellaneous that will be for $0 to those various borrowers, at least for amounts that come out of this program. And they also make it pretty clear that if you don't do this, you may be penalties, because what they're telling us is if you get it done within 30 days, right, of the December 31st furnishing deadline, you'll have reasonable cause for failure to furnish penalty. The flip side of that is you assume that if you don't get it done within 30 days, so by early March, you don't have this corrected, that there is not reasonable cause for failure to file, and they will start assessing that non-provision of information, right, in the same way. And again, the same problem with you didn't provide a valid copy to the IRS. And since the copies were erroneous, actually, let's face it, there shouldn't have been any copy there. Yeah, the implied threat here is get it done by basically March 2nd or face the penalties. So, yeah, the banks are being told in not subtle terms that they need to fix this. And, we're not going to sit back and just say, yeah, it's voluntary, do what you want. The IRS is looking at all the CP 2000s that would be issued and saying, if we're going to have pain here, you're going to have pain. So we'll see how that goes and what the banks do. As I say, this has been the update week. Interesting enough, I finished up this week. I finished up most. I still have a New Jersey course coming up later this month that is going to look at the PPP2 loan program one last time, where we're at, roll forward to what we have at this time, take a look at that background. So kind of mainly a rehashing of what we did before, but we will look at the new things that have come out since then and any other new developments. But for the most part, we're at the end of CPE season. I say that because, as you're aware, on February 12th, the IRS will open up electronic filing. Most CPA firms are beginning to receive data from at least some clients, maybe some business clients. They have data in, so there's stuff that can be done. And when we get to February 15th, the consolidated 1099s go out. I know in this industry, we talk about continuing education, there is way less interest in courses, and that interest will stay down from February 15th for the next 2 months. So we're not going to have a ton of stuff going on in terms of coursework. We still may have a few, short little blurbs. I may do some short 1-hour EA, CFP, and, well, it works for CPA credit too. Monthly tax update stuff. But that's going to probably be mainly of interest to people that aren't in tax, but they want the credits, so they indirectly get it. So we'll take a look at that. But we will keep up here to find out what's going on with our updates. So check in here. If you have a question, you can email me, edzollers@currentfortaxdevelopments.com. If you want to, and you're a member of the societies I monitor for Connect, you can take a look on the Connect boards on Arizona, New Jersey, Illinois, Minnesota, Washington. And, we'll take, if something new comes there, I try to watch there some and respond some if I get a chance during tax season. It'll become a little tougher, but we'll try to keep up as best I can. And otherwise, stay tuned. If we get a new tax bill, yes, I plan to talk about that in detail, but I'm not going to talk about a new tax plan in detail until such time as it's a lot clearer what would be in it, rather than going through Votorama, which is what we have right now in the Senate, and watching that on a reconciliation bill, which, as we know, there is no room for error whatsoever, because the reconciliation bill basically is saying that the majority party is going to try to ram this through with only their own votes, or at least, certainly they can't get enough votes to get to 60 votes in the Senate. That's what they're telling you. And that means probably, since they would ram it through with no Republican votes, they've got to keep every Democrat in line. And right now, that appears to be very, very difficult. Certainly, I expect the bill to have to be watered down fairly substantially compared to what was initially proposed if they're going to get the votes of people like Manchin to pass the bill. So we'll have to watch. That's why I don't think it makes a lot of sense for me to spend a lot of time, analyzing in depth any current proposals. And frankly, some of the proposals I believe right now have no chance whatsoever. And so, despite the fact that I see people wasting a lot of time discussing them, it's like, look, as soon as if they actually vote, it's actually in the bill that gets sent to the president's desk. Then we'll talk about it. But until then, I'm not wasting a lot of time on the wealth tax, mark to market, etc., until I see a realistic chance it's getting there. So we'll just look at it that way. But if they do, we'll talk about them and anything else that comes up. So we'll see you back here next week on current federal tax developments.